All right, guys, Shopify just announced earnings and revenue. It missed on both. Now, remember, I don't focus too much on the short term, but for those of you who like to hear about it, they were expected to make 2 cents per share. They lost 3 cents per share. They're expected to do 1.33 billion in revenue. They did 1.3 billion in revenue. Now, the reason it doesn't matter to me on the short run is I'm a value investor. I like to sit there and look at the long term of a company. Companies can miss here and there, quarter to quarter. We don't want them to hit every single time. If they are hitting every single time, they're probably manipulating earnings and revenue in some fashion. So we don't want to see that. We want to see, is the trend still going? It's kind of like in school. You're going to have a few bad grades here and there. The point is, you don't just all of a sudden, because you have one bad grade, you're dropping out of school and you're a miserable failure. No, you regroup, you go back and refocus. That is the key to investing. Now, the thing about Shopify is, let's go take a look at their stock price in our Everything Money software. It hit a high of 176 in the last year, a low of 30, and now it's currently at $35 a share. So that's pretty tough. So again, if you're new to this channel, if you're new to this video, I'm Paul, I'm a value investor. That guy over there, that's Mo. He's a day trader and value investor. We're here to talk about the long-term approach of looking at companies. We want to teach a process in which you love when stocks go down. We literally get sad when stocks are up. You'll literally see us go, Now, that's easy to say you're going to do, but when stocks start to go down, do you have the ability to go buy more? So the question you also have to ask yourself is Shopify a good deal now? You see 176, you see 30, and a current price of 35. You think to yourself, this thing's on sale, it's down 80%. Pump the brakes. Just because something is lower does not mean it's a good deal. If you don't think that, let me give you an example. If I had my house, and let's say my house in a normal market's worth $300,000, but I want to sit there and fool somebody, I'm going to ask $1 million. And then a week later, I'm like, you know what? I'm going to drop the price to $600,000. You, the smart investor, would say, but wait, it's still only a $300,000 house. Why should I pay $600,000 just because it's down from $1 million? It's still only a $300,000 house. Same applies to stocks. We want you to view companies and stock prices as different things. Love the company, hate the stock price, then you don't buy the stock. That's the key here. So let's go use our 8-pillar analysis to go evaluate Shopify right now. And again, if you have our software, if you're a member of it, please follow along if you're part of the community. If not, go to everythingmoney.com. You can learn to sign up there. So some of the things I want to look at before we look at our 8 pillars, guys. This is a $44 billion company that has a 9 price to sales ratio. Now, when it comes to companies that are losing money or software, I like to compare these things. So Shopify has a 9 times price to sales ratio. Let's go look at a company like Microsoft, which is, I believe, overpriced. And it's currently at a 10.67 price to sales ratio. So I look at that saying, okay, Microsoft's overpriced. Shopify is almost at their same price to sales ratio. Microsoft's gross profit is 68.7%. Shopify's is 53%. I'm not feeling it on the Shopify just from right then and there. But let's go look at our 8 pillars tab to see where the company falls in terms of all of its metrics. All right, big numbers here, guys. PE, 5-year PE and 5-year price of free cash flow are nosebleed. Absolute nosebleed. And of course, the story is, well, Shopify's growing. They're growing like crazy. Great. You know what else they're doing? They're diluting the heck out of you. They have 40% more shares outstanding today than they did 5 years ago. That's a lot, guys. Now, debt. I'm not worried about this debt number. This is our long-term liabilities divided by the 5-year average free cash flow. Why am I not worried about this number? Because they're barely making cash flow. Their 5-year average free cash flow is $145 million. They're probably going to have a really, to me, that makes their debt about $1.3 billion on $4.8 billion in revenue. Okay, that doesn't seem bad. So this is an example of where using the 8 pillars on a young company won't tell you the real story. I'm not saying this debt level is okay, but it doesn't alarm me. These are the big alarming numbers right here. These are the ones that scare the bejesus out of me. Now, they're growing revenue, they're growing net income, and they're growing on cash flow. That's awesome. But you still have to sit there and say, what should I pay for this company? Well, this is exactly why we created the stock analyzer tool. But before we get there and put our numbers in to decide what we're going to pay for the company, just because Shopify may be overpriced doesn't mean you can't make money from it. And Mo will tell you how to do that using charts.
Guys, this incredible fall on Shopify. So here's a great opportunity. This is what I call a dog stock and why you would put a tracker share on something. And a tracker share is buying one share so you see it in your account every day instead of getting lost on your watch list of 50 stocks. You could pull this out and see it every day. Here's the big fall. They've fallen from that 180 number down to, 35 now? But my pay attention to right here is this stochastic on the bottom. It just keeps going sideways on the bottom, on the bottom. Eventually, if this company sticks around, which I probably think they will, this number will just start, this stochastic will just start to creep and creep and creep. And the price will just start creeping and creeping. Eventually, it'll start moving up and you'll be the first one in and you'll be able to squeeze a little bit more profit out of there. That's why I like this one so much. But for right now, if you want to be active with it, you can come over here to a swing trading chart and see what you can do. There's a lot of moving averages that you're sitting right under, right on top of. So if you get some type of move over this 100-day, you'll have some type of nice run. If you can get below the 50 and the 25, you'll have a nice run down. So this is giving you a lot of options. Long-term, short from a swing trading perspective, long from a swing trading perspective. There's different ways that you can approach this one.
All right, so now we've looked at that. The stock analyzer tool is what we created because every investment's a present value of all future cash flow. So we don't know the future. So our job is to make assumptions about the future, put it in the stock analyzer tool, determine what to pay for the company. So let's go right there. So first off, guys, you got to pick number of years of analysis. 1 to 20. I always have it start standard on 10 because I do think Shopify will be around for a long time. Okay, it is a very good service. It puts a lot of people immediately right there to be able to get their online stores running. All right, now revenue growth. Guys, 10 years ago, about 8 years ago, they did $18 million in revenue. Last year, they did $4.4 billion. This is probably not very sustainable, okay? So I want you to exert some caution here because that's the key to everything in investing. You want to be cautious and then buy for less than that value. And it sounds boring, but this is how the best investors of all time have done it. So would you rather make money or be excited? I'd rather make my excitement from making my money. So here's what I'm going to do. Revenue growth. I'm going to call it 8, 11, and 14. And if you think I'm conservative on that one, let's look at what 14% revenue growth for the next 10 years would take Shopify to. About $16 billion in revenue, almost quadrupling their revenue. All right? That doesn't seem crazy. That doesn't seem overly aggressive. It doesn't seem low. It's just fine. Now, maybe, you know what we'll do? We'll do 8, 12. Now, I like the 8, 11, and 14. Now, we'll do 16% on the high side. Now, profit margin. Now, here's the key, guys, on profit margin. They haven't made much money lately, so I don't know if this is an accurate profit margin. I'm actually going to do something very interesting. I'm going to do 12, 16, and 20%. I'm really going to go above that because it's a newer company. They've had low profit for a while as they grow. I'm not going to sit there and punish them for their past years when they were spending all their time growing and spending that money. Free cash flow margin. I'm going to do 10, 14, and 18%. Just a little bit below profit margin because they're still going to spend a lot of money growing as time goes on. Now, PE and price to free cash flow. Guys, the 1-year PE is 240. The 1-year price to free cash flow is 174. So this is probably the biggest complaint we get from people. Oh, your PE is too low. Oh my God. Fine. The PE is too low. I'm going to give a wide range. I'm going to start with the market PE at 15. I'm going to do 20 and 25. Now, the only thing I don't like about this is the higher and higher the PE, the more growth potential is left over. As it grows and grows and grows, it will have less potential to grow more. Eventually, Amazon cannot grow 30% a year forever. It's just not going to happen because then they'd be bigger than the world economies, which is literally impossible. This is part of my thesis about crypto. When somebody made a video talking about crypto had 19% gains for the foreseeable future for the rest of the time, I was like, so in 40 years, it's going to be larger than the world economy. That was my point of that doesn't even make sense. So finally, desired return. Now, usually I do 12.5%, but here I'm going to go 15% across the board. Why is that? Well, there's a lot of unknowns with Shopify. And the more unknowns and the less you have available, I got to put that 15% in for a higher margin. So when I hit this analyze button, it's going to spit out a bunch of prices for me. And they're going to be in green or red. If it's green, it means it's below that price, that your value is below the current price. If it's red, it's above it. Now, if it's all green, that doesn't mean go out and buy it. It means go do your research and make sure these assumptions are reasonable. Join our community. You can have conversations with other people about Shopify. I was just in our chat today and saw somebody mention Shopify because of earnings results. If it's all red, it doesn't mean avoid it. How far away from the red are you? Are you right within there's all these things. That's the art of investing. You can't just make a decision based on this. You have to make sure you do a little bit more digging. So I'm gonna hit the analyze button. The stock's currently at $35. Drum roll, please. All right. Low side, 6 to 7. High side, 28. Middle side, about 13. Now you might sit there and say, oh my gosh, that's so far. Go back to our past videos when I talked about Peloton and Palantir and how I thought they were worth around $5 a share and $10 a share when they were at 180 and 40. And guess what happened?
And this is falling from 180, so
there you go.
It's a lot closer to the low than the high.
Be patient, guys. This is the way it is. If you'd like this video, please share it and subscribe to our channel. I appreciate your time.